If you watched our last video, then you know we talked about a specific industry that's absolutely been crushed in this recent market rout. Now, the benefit of market corrections like the one we're in is that you're going to see stocks and industries that have been hurt too much. They didn't deserve the beating that they got. Now, a lot of stocks did, they were just asking for it the way they shot up and with their valuations with Cathie Wood and all that. But some of them didn't, and those some are the ones that we're looking for because that's where you could get the best deals. Now, one particular sector that has been hurt the worst is biotech. You can look at XBI right here. This is the biotech ETF. From the highs, it's down over 60% right now. This, as we explained in a previous video, is one of the worst bear markets in history for biotech. So the current sell-off has brought this ETF down to its 2018 and 2020 bear market lows. Now, if we zoom in a little bit, what do we see here? We got a nice little reversal. And now look how tight it's trading. You could draw the little lines if you need to right here, and you can see it's trading in that tight range. This is a good sign. How long it's going to trade in that range? We don't know, but that's why you watch it. You put it on a watch list. And one thing that tends to happen is that this could base out and keep going sideways until this 50-day moving average comes and meets it. And then what you're really looking for is a breakout beyond this little consolidation right here and above the 50-day moving average once it comes down. And that's a good signal that this bear market has turned around. And the reason we're looking at this ETF even before we get into the stock that we're going to talk about today is because 30% of this stock's movement is going to come from its overall sector. This is what Steve Cohen explained. And if you don't know Steve Cohen, he's the guy who got in a lot of trouble with the government, but actually escaped scot-free. So he had to shut down his hedge fund and then open up his family office. Bobby Axelrod in Billions, that's the guy that he's based off of. But anyway, he says that 50% of a stock's move comes from the overall market, 30% comes from its industry, and then 20% from the stock itself. But of course, in Steve Cohen's world, 100% of a stock's movement comes from insider information. But for the rest of us, yes, 30% will come from the industry. So that's why we're looking at this biotech ETF as a whole. And this type of consolidation is what you like to see. Now we are still in the early stages of this consolidation. It's only been a few weeks, but this is what starts clearing out all the sellers. And then you have a bunch of strong hands building up. That's what you need to see for a real trend. Now, to help us with digging into the biotech space, we're going to refer to a podcast interview we did on our Value Hive Macro Ops podcast. And that interview was with Peter Mantis. So Peter works at Logos Limited Partners, which has generated a 22.58% compounded annual growth rate since its inception in March 2014. So he's a pretty smart guy. So the first thing we talked about, and this is Brandon who interviewed him, is what's happening in the biotech and life sciences area because it's been beaten up so bad. So as we already said, it's experiencing its most significant drawdown in history. So Peter said that what we're seeing is the equivalent of negative oil prices. That's how beat up it is. So there's a couple of reasons why this happened. First, COVID completely shut down multiple drug trials, and that in turn rapidly reduced the terminal value of early stage drug companies. So what is terminal value? Well, it's kind of a valuation term. So when you're doing a discounted cash flow analysis, you could only project so many years into the future, and after that point, you call just terminal value. You assume that the same profits continue forever. Now in biotech, it's a little different because in biotech, what are you dealing with? You're dealing with drugs, right? And with those drugs comes patents from the FDA approval and everything. So you get all of that mixed in. But what happens is when those companies create that brand new drug, they make all their profits within the patent period. Because after that patent expires, that's when you have every other drug company flood the market with generics. And when that happens, that original company that created the drug, their revenues drop over 90%. They're basically done. So for biotech companies, it's basically incorrect to model any terminal value in the sense that after the patent is over, the company's done. That's what you have to put into your valuation. So by multiple drug trials being shut down, that basically reduced the time frame for these companies to be successful. Because when you're investing in biotech, it is very tough. It's very much based off if this particular drug is going to pass the trial or not. And there's different phases and everything. And we'll talk more about that in a second. But the second thing that happened is that many early stage drug companies IPO'd during the ARC-driven momentum mania. And those were at ludicrous valuations. And I already mentioned that. That's when Cathie Wood was a star of the show and everything was going up like crazy. But as we've seen, it never stays like that. And that's why ARC is still down over 70%. So now what's happened is that a record number of biotech stocks are actually trading below net cash. So what does that mean? That means that their market capitalization in the stock market, which is what market capitalization is, but basically their value in the stock market is actually lower than how much cash they have on their balance sheet. And when I say cash, I mean cash minus debt. Basically, their cash value is higher than what they're being valued at in the market. Now, for a value investor, obviously that sounds amazing, right? Because that means that the stock is being undervalued. Well, in its most simple terms, yes. But at the same time, you got to understand that there's a reason why the market is valuing it so low. If a company is being valued below net cash, that means its growth perspectives are terrible. They don't think this company is even going to survive. So on one hand, it could be a huge opportunity, which in this case, spoiler alert, if we're talking about it, yeah, it probably is. But on the other hand, it could just be a dud. Most of the time, it's going to be a dud. So according to Peter, these companies are trading below cash for a couple of reasons. First, the delays in drug trials have substantially reduced terminal values as these companies race against patent clocks and FDA procedures. So that's what we talked about, right? If your drug trial gets shut down, well, now you just have even less time with your patent before all your revenues go away. Every minute a drug isn't going through the trial process accelerates its terminal value decay. Again, running out of time. So that's why the market is pricing these things below cash. The market says, yeah, you have 12 to 18 months left of cash before you go bankrupt, because nothing's going to happen with your trial shutdown. And that's also due to COVID delays and lofty IPOs. So another thing that happened in this space is that a lot of money flooded towards any companies dealing with COVID. And those are the ones that got the lofty IPOs. And not only the IPOs, but valuations in general, because those companies became super earners during this whole pandemic time. But eventually, these companies are gonna mean revert. And as they do, the rest of the space will look better as well. Because it's all a comparative game, right? What's your best option? If all these COVID companies are doing great, the rest of the biotech space probably getting hurt. So Peter thinks the market is overreacting to a few things that are not currently priced in, such as clinical trials reopening, COVID deceleration, and the number of compounds that are in phase 1 through 3 trials. So basically, Peter is betting on the market realizing this second wave. So the market will realize that some biotech companies are great businesses with strong balance sheets that aren't merely COVID beneficiaries. Now, one of Peter's favorite ways to play the biotech and life sciences industry is through regulatory tax and toll capture. So this is a good framework to use not only for biotech, but other companies too. And you'll see in a second how Warren Buffett does it a lot. So companies operating in RTTC are some of the best businesses in the world. And that's because they get stuck in all this regulation in a good way, because they have ironclad customer lock-in due to FDA regulation. And they generate supernormal profits because their costs are pennies and they charge dollars. So here's how it works. Anything that touches human skin or touches the drug needs FDA regulation and approval. So needles, syringes, cannulas, drug packaging, delivery mechanisms, everything. Now these approvals take years and they cost millions of dollars. So once a company gets one, they're set, right? And these things like needles, syringes, and all that are such small costs for a drug company that there's no incentives to switch providers. Because if they did switch providers of whoever's giving them that stuff, they need to reapply with the FDA and start the approval process all over again. And nobody wants to do that because you're up against your patent clock, right? You have that terminal value. You need to make as much money as you can before the generics flood the market. And when you're up against that patent clock, you're burning cash. So here's something that's crazy. 90% of drug biologics pass through West Pharmaceuticals, and that's a device maker, ticker symbol WST. So in effect, WST is the gatekeeper for delivering drugs to people, and that's an incredible RTTC. They basically have an unmovable moat because no drug company wants to switch providers. Why would they? It's just a mess if you do. So when you're investing, if you could find a company that's just entrenched like that everyone has to go through, you can bet that's going to be a good business to invest in. And you'll see how this relates to the stock that we're about to talk about. But this framework of finding these stocks is exactly what Warren Buffett uses. In fact, Warren Buffett, the friendly old grandpa who's actually not friendly at all, will pass regulation himself, use his influence and all his money to make sure that the company that he's invested in stays entrenched, even if it hurts lots and lots of people. Yeah, Warren Buffett actually sucks. He has so much money but still does things that hurt people just so he can make more money. And it really doesn't make sense. I understand loving the game, but you shouldn't love it so much that you're willing to sacrifice the general public. And if you don't know what I'm talking about, don't worry. I'm going to link to a video that we did at the end of this video so you could go see how Warren Buffett uses the same framework that we're talking about to just take advantage of all of us, really. Yeah, he's not a friendly grandpa. Now, the company that we want to talk about today in the biotech sector is ClearPoint Neuro, CLPT. And you remember we just talked about about this in the last video, but let's dig a little deeper. So CLPT is a neurological platform company that enables neurosurgeons to perform minimally invasive procedures under real-time MRI guidance, which is pretty cool. So CLPT allows doctors to see the entire map of the brain in real time as they implant electrodes, perform biopsies, or trigger deep brain stimulations. So the most important part is that you get the MRI scans in real time while you're in the brain. And that's obviously very important, and it's something that they didn't have before, because you want to be able to see the full picture, a 3D picture of the brain while you're playing with it. Now there's two segments to CLPT's business. Functional neurosurgery navigation, and I could barely say that for some reason, and biologics and drug delivery. So the one we're most excited about is the biologics and drug delivery business. And the reason why is because of the regulatory tax and toll capture model that we just talked about. So CLPT basically has a chance to become the toll road for drug delivery straight to the brain. So here's Peter explaining it a bit. A therapy that can help the brain of a Parkinson's patient might also destroy a liver or a kidney. So if you deliver that Parkinson's treatment orally or through the bloodstream, you risk that therapy damaging other organs on its journey towards the brain. So this is the case with a lot of drugs actually that help serious situations. So for example, if you have any type of organ transplant, you're taking like 100 pills a day because you got to suppress your immune system and a bunch of other stuff. But what happens is some of those drugs are really hard on your liver and kidneys. So within the next 5 years, if you even make it that long, because a lot of transplant patients, because you don't have an immune system, you actually die in the first 5 years from like a cold because you're not careful. Or if you get the flu, you're really screwed. But if you make it past that point and you keep going, eventually you're gonna need another transplant for your liver or your kidneys because they stop working. That's the problem with a lot of these drugs. So they fix one problem, but then create another. And that's not because we want them to work like that, but it's basically the best that we have. But if you have something like this CLPT, you can do real-time guided delivery of gene therapy drugs directly into the brain. And that way you're bypassing all the organs that you'll eventually shut down with these drugs. And you're delivering them right into where they're needed. So if they can go right into the brain, that's huge. And these gene therapy costs that we're talking about, they're expensive. So once this delivery mechanism is FDA regulated, well, there's your moat right there. So every company that has those drugs that get delivered straight to the brain, they got to go through CLPT because they have the patent thing. So they're the toll road, and that is a great business. And we talked about this a bit in the last video, but you can see the price chart is already updated. We talked about how this was a 5-month basing period, which is very strong. And actually it's more than 5 months, it's like 6 months. But we drew this resistance level right here, and we talked about how this resistance level is a resistance because it has supply overhead or overhang. It's either works. But basically when you get up to this price point, all the people that bought here start selling. So I'm recording this on a Friday. You could see Thursday we just launched up right into that resistance. So now we got to see what's going to happen. Will it break through or will we go sideways for a little bit? Because you're going to get some selling right here. But you see every time you hit that point and come down, see this is the third time, right, that we're hitting it, that resistance weakens a little bit because you get those people selling each time and eventually all the weak hands are going to be gone. So this is the same thing that we just talked about with the biotech ETF, right? You get rid of all the sellers and then you have the strong hands left. And in the previous video, we also talked about how this 200-day moving average will likely come down and touch this same resistance point. That's just how it tends to work. So if I had to bet here, I would say that instead of breaking through right now, we might go sideways for a little bit right here until this comes down, and then you'll have a combined resistance where if you break that, then you're really off to the races. So this is a beautiful point right here in this stock CLPT. And the reason why that 200-day is important is because, again, that's a place where people bought and they'll want to sell again, even though this constantly moves. It's just a marker that everyone uses. But this is one of those stocks where you definitely want to wait for that breakout because you don't know what's going to happen. You don't want to be sitting with dead money. So for example, if we thought CLPT was a great business back here, this was February, and it was a great business back then, well, if you try to invest right here, what would have happened? You'd be just basically dead money for months on end. And you don't want to lock up your capital like that. That's why even when we do this value deep equity investing at macro ops, we still combine it with price action because price action is going to tell you when to actually get in the stock. Otherwise, man, if you just focus on value, you'll be in a dead stock for years. And then you'll look at your returns 5-10 years from now and you're like, oh man, I suck. But this company is still great, so I don't understand. That's what happens. You can't control when the market is going to realize what you realize. That's why we would rather wait for the market to realize that the stock should go up before we jump in. Then we're moving with the trend. So yeah, definitely keep this one on your watch list because there's a lot of things going for it, especially as the general market begins to turn around here, at least for the intermediate term. Now going back to this regulatory tax and toll capture, I really want you to check out the Buffett video right here because you'll see how he truly abuses this framework because of how much power he has. He can basically create that moat himself. It's ridiculous. It's interesting too, but yeah, he's the worst. So click this video right here and I'll see you there.